Welcome to ForexTV.com. Today is Thursday, October 16th. I'm Remy Hookie for New York Forex Market Buzz. The dollar is higher against the euro, pound, yen, as well as the dollar block currencies. It's been another choppy session with equities seeing extremely volatile trade and commodities selling off. Now for a look at the latest headlines from the CP News Desk. There was a slew of U.S. data releases this morning. Net long-term tick flows came in below the consensus forecast, totaling $14 billion in August. The tick data for August showed a net long-term capital inflow of just $14 billion with foreign demand for agency bonds soft. Total acquisitions of long-term securities by foreigners fell by $8.766 billion from $25.59 billion in the previous month. And U.S. September industrial production tumbled down by 2.8% versus the 1.5% estimate. The Fed said that the two hurricanes, Gustav and Ike, accounted for 2.25 percentage points of the decline in industrial production. That is the largest drop since December of 1974. Meanwhile, U.S. September capacity utilization came in at the lowest since October 2003, down to 76.4 versus 78.7 in August. And the seasonally adjusted U.S. CPI came in flat for the all items index and rose less than expected in the core, with core CPI up by 0.1% in September. Annually, the all items inflation is up 4.9% and core inflation is up 2.5%. There are no revisions to the prior month's data. Meanwhile, initial claims for unemployment benefits fell back to 461,000 in the week ending October 11th. That's down from a 7-year high of 499,000, which was reached 2 weeks ago. And continuing claims rose to 3.711 million for the week ending October 4th. The 4-week moving average for initial claims is up slightly to 483,000. And the Philly Fed's manufacturing index for October tumbled to an 18-year low, with the general activity index down by its largest margin ever to negative 37.5 in October from a 3.8 reading in September. That is the lowest reading since October of 1990. Meanwhile, crude oil futures continue to fall, now not only below the $70 barrel, but extending losses below $69. For the second straight week, U.S. crude oil supplies surged by a much larger than expected margin. Supplies jumped 5.6 million barrels, with gasoline stocks up by 7 million in the latest week. Demand for gasoline is on the decline, down by 5.2% year over year. And speaking in an interview on Bloomberg, Treasury Secretary Henry Paulson said he expects the U.S. economy to perform well once the turmoil subsides. Paulson said frozen credit markets have exacted a toll on the real economy, saying that while work has been done to limit the number of home foreclosures, they are still too high. And Federal Reserve Chairman Ben Bernanke has been summoned to appear before the House of Representatives Budget Committee on October 20th. He will testify on a potential second economic stimulus package. Democratic leaders at Capitol Hill are reportedly pondering the introduction of a second economic stimulus bill. Joining me this afternoon to discuss the major currency pairs is Peter Watkins, Senior FX Market Analyst at Thomson Reuters. Good afternoon, Peter.
Good afternoon. How are you, Remy?
Good, thank you. Thanks for joining me today.
Always a pleasure.
Well, we had a whole slew of U.S. data releases, a sell-off in equities, then a rebound, but now the major indexes are trading mixed. And the plunge in commodities we also saw on top of concerns about global recessions. So as we continue to weigh the fallout from the credit crisis and its effects on the real economy, in the short term, do you expect to see extended losses for euro-dollar?
I think that the euro, if it doesn't rally within the next 2 days, is definitely vulnerable to a sell-off. The feeling I get is that asset managers are getting very nervous, particularly some who've held long-term positions in the euro, where break-evens are starting to become threatened at current levels. There was an interesting piece put out by one of the ubiquitous New York tech teams earlier in the week, saying that if you've got a bounce in the euro, you should trounce it, i.e. sell euro. They were hoping to be able to sell up in the 138 to 140 area, and they were looking for that pullback into next week. But the way things are shaping up here at the end of the week, it doesn't look like that bounce is materializing, and I think one of the big drags on it is the continuing poor news coming out of Europe, particularly when you find out that UBS, one of the true global banks, one of the top 4 banks in foreign exchange, had to get a government loan of $60 billion. It just puts everything into perspective.
Well, Peter, while we keep an eye on what's developing overseas as well as here in the U.S., in terms of the equity market, the major indexes are back down again. And looking at the VIX, we can see that volatility is once again at record highs. But how are you factoring equities with your forecast for the yen crosses as well as dollar yen?
Well, basically, equities and dollar yen are just following step by step what's going on with the equity market. And it's amazing how interlocked they are at the moment. So the volatility that you see in euro yen particularly, which seems to get hammered the fastest, particularly on the downticks, is really quite astounding. But until US equity markets can stabilize and show some consolidation, then we're going to continue to see pressure on the yen to strengthen both against the dollar and on the crosses. A key level is where we looked at the other week. I think the low was 97.50-ish. If we get below that again, it basically opens up the dollar yen to go all the way down to the record low of 79.90. So from a technical perspective, these levels in dollar yen are very important. We have seen some pretty heavy buying between 99 and 101 in dollar yen. I think it's related to the fact that equities do seem to keep bouncing back from their lows. What we have to wait to see is whether or not we can string together a couple of days of up days here in New York, because without that, dollar yen is going to be vulnerable to further selling.
Well, Peter, while we all keep an eye on equity markets and as investors and market players are all looking for that bottom in the stock markets, let's also take a look at commodities. Now, the sell-off not only in crude but also gold has been swift and is also weighing on the major currencies. Oil and gold continue to take out key levels here. So for the dollar block currencies, how are you adjusting your strategy?
Oh, we really haven't adjusted them too much. I mean, we've been on a downward slope in oil for some time now. I think the thing that has happened is that it has accelerated the demand for US dollars against Canada, driving it up to 120, 120 last week. Without a doubt, if oil hadn't been as weak as it has been, dollar Canada wouldn't have gone up that far. Gold has been lagging oil basically because of the fact it's acted as a safe haven play. It's interesting that now the Treasury is issuing more T-bills to fund these bank bailouts and things. Gold is starting to tail off, and it's almost as if there just wasn't enough supply of US T-bills out there, and now that the T-bills are getting released into the market, then people who were holding gold are switching into the T-bills just to get a little bit of an interest play. I think that gold is vulnerable. It's been holding up just purely on this risk aversion. The oil-gold cross normally holds up quite well, but has completely disassociated over recent weeks, and probably gold has to play some catch-up there. There were some technical forecasts that came out this morning indicating that gold should basically be on a down slope just by virtue of the fact that the resistance levels have slipped down now to the 855, 875 level, and it wasn't breaking higher.
Okay, Peter, last but not least, we've touched on most of the majors as well as some of the crosses and hit on equities and commodities, but I do want to take a quick look at sterling. For sterling against not only the dollar but also the euro, in the short term, what is your forecast?
Well, sterling's interesting, actually. I think it stands to gain against euro. I think that overall, the fact that the British government, Bank of England, moved earlier than the ECB did, and further down the curve with the bank bailout situation, I think that sterling has an opportunity to continue to gain. I mean, we got down to 77.35 lows yesterday. I don't see any reason why that can't continue. I mean, the euro peaked at around about 82, and I think that what we're probably going to see there is, euro sterling move down closer to the 75 level. On the other hand, that doesn't necessarily mean that dollar sterling is going to be significantly higher. If anything, I think that the dollar is probably going to continue to benefit from repatriation from U.S. asset managers, and also from the fact that the U.S. authorities have been addressing the credit crunch and spiraling markets for 15 months now, whereas Europe hasn't. So I think the dollar continues to strengthen, and I do believe that we will see sterling slip back below 170 again, as we saw just last week. And if we break below that 167 level, that will be a key. We'll probably be looking for, closer to 160-ish.
Okay, Peter, we're all out of time for today's interview. Thank you very much for joining me, and thank you very much for insight and analysis into the Forex marketplace.
Okay, you're very welcome.
Thank you. This has been your Forex Market Buzz with Peter Wadkins, Senior FX Market Analyst from Thomson Reuters. I'm Remy Hoki. Join me later this afternoon, 4 p.m. exchange, right here on ForexTV.com.